All right, chapter 14. This is the second chapter on lending. We have three chapters on lending, 13, 14, and 15. This is the second chapter. So, financing one, conventional FHA and VA loans. In this chapter, we're going to describe issues concerning mortgage financing, including various payment plans. We're going to distinguish differences among conventional, insured, guaranteed, and some New Jersey home loan programs from home buyer programs. So, with mortgage financing, the home purchasers often require a down payment and a loan because most people don't have all the cash necessary to buy their house outright. So, in order to get a loan, lenders charge interest. That's what's in it for them. They charge interest. Interest is the rent. It's the charge. It's the rent to borrow and use someone else's money. And interest is calculated, the math of it, it's calculated on an annual basis. So if you calculate interest, say you got a $100,000 loan, you got a 5% interest rate, $100,000 times 5%, that tells you what the annual interest payment is. Divide that by 12 because there's 12 monthly mortgage payments usually, and that'll tell you how much of that first month's mortgage payment goes towards the interest. So you could subtract that from your monthly mortgage payment, and you'll know how much of your first monthly mortgage payment goes towards paying down the principal, the amount you borrow. So value equals 100%. Anytime we're talking about value, we're trying to calculate it all. So value means 100%. And an LTV is a loan to value ratio. It's how much the lender will loan you in relation to the appraised value, not a ridiculous offer price on the property, but how much they'll loan you in relation to the appraised value of the property. Now, typical lending, conventional loans, it's a LTV is 80%. The lender will loan you 80% of the value of the property, so you need 20% down. There are loans out there that are conventional that may require less, but that's that. Okay, your FHA loans, FHA only requires a 3.5% down payment. So the loan to value ratio, the LTV, is 96.5. The lender will loan you 96% of the appraised value of the property. So the borrower needs to put down the other 3.5%. So you could use that. If the lender tells you what the LTV is, you could figure out what the minimum required down payment is, 3.5%. So hopefully your borrower has that money. Right? So what is equity? At the time the buyer purchases a property, their equity is equal to their down payment. It's the built-in value. It's the difference between the value of the property, the market value of the property, and what's owed on it. At the time that you purchase a property, you make a down payment. So that difference, that down payment amount, is your built-in equity. Market values can just simply go up, increasing your equity, or you can do home improvements, further increasing equity. Equity is your built-in value there. It's the difference between the market value and what is owed. So let's write that there in your book too. Equity is the difference between market value and what is owed. That's on the first page in chapter 14 at the bottom. And these are the three ways you could typically build equity. So interest is the rent the borrower pays the lender for the use of their money. And the amounts of mortgage loan in relation to the home value is the LTV ratio. Loan to value. That's what LTV stands for, loan to value. How much they'll lend you in relation to the value. So that LTV ratio has increased from 40% in 1920. Times was rough in 1920. You know, the lender will only loan you 40%. You needed to come up with the other 60% down payment to get a loan to buy a house in the 1920s. Now, I know you may be like, well, how much were homes worth in the 1920s? Yeah, well, how much were people making in 1920 as well? Plus, that was the time of the Great Depression. You know, a lot of people had trouble with jobs, right? A lot of people that were starving. So it also increased to as much as 95 or 100% today. Payment periods have also lengthened from 5 years in the 1920s to as much as 30 or more today. Wow, 20s were a rough time. You needed to have 60% of the cash to put down as a down payment when you got a loan, and they only gave you 5% to pay 5 years to pay back the to pay off the loan. Yeah, it's tough getting a loan in the 1920s, I guess, right? Now, interest rates are charged by lenders, lending institutions on home mortgage loans, and they vary as changes occur in the money market. Those interest rates fluctuate. As interest rates move up, an established fixed rate mortgage with a low interest rate may be a plus when selling a home if that new owner is able just to assume it and take over the payments. On the other hand, if mortgage interest rates fall, the homeowner may seek to pay off their loan and refinance at a lower rate. To buffer the effects of unstable money markets when the lenders aren't lending, really, lenders have been offering many alternative forms of mortgages in recent years, like adjustable rate mortgages. Seller financing also gains in times of tight mortgage money where the lenders aren't lending. For years, potential homeowners have been able to receive assistance in obtaining low down payment mortgage loans through government programs like the FHA, the Federal Housing Administration, which requires a low down payment, or through the Department of Veterans Affairs, the VA for veterans or active military personnel. They could get up to 100% financing. The VA will guarantee 25% of the payment to the lender. So it's as if the borrower put down 25%. The lender knows that if the borrower fails to make payments, that the VA will cover 25% of the loan. So it's as if they made a 25% down payment already. So in addition to that, private mortgage insurance companies have been offering programs that enable loan applicants to receive higher LTV ratios than normal. They have something called PMI, private mortgage insurance. All right, so interest rates, they fluctuate as in the money market on a regular basis. They go up, they go down. When interest rates are high, alternative forms of financing are more attractive, like adjustable rate mortgages. But you don't want to stay in them for the long term because the rates go up, they go down. Government programs may allow for a higher loan to value ratio than normally allowed. So basically a lower down payment. You know, FHA only requires 3.5% down. It only used to be 3%, but we had that whole mortgage market meltdown and all those government bailouts. So then President Obama changed the rules, and he raised it to 3.5% requirement in order to buy a house using the FHA program, that you now have to pay 3.5% down payment as the minimum. But then when it came time for his reelection year, he did what a lot of presidents do, and they manipulate the system to try to make the economy look like it's doing better under their guidance. So what he did is he lowered the requirement for the down payment again back down to 3% to get an FHA loan. Yeah, he did that. He's the one that raised it. He raised the minimum requirement on FHA loans from 3% to 3.5%. And then when it came his election year, he lowered the down payment requirement to try to get more people to rush out and buy homes in this temporary time that he lowered the down payment requirement for FHA loans. Okay. Why would he do that? I mean, why did he raise the down payment amount to 3.5%? Well, because of all of the mortgage meltdown, all those foreclosures, the FHA insurance program required a bailout under Bush and then a second bailout under Obama that was even bigger. And said, hey, this thing is bankrupt. We need to keep funding the FHA insurance program. So we're going to require borrowers to have more skin in the game and put more down payment. So 3.5% sounds good. Well, then why did he lower it in his reelection year to 3%? Because these are the games that presidents sometimes play to try to make the economy seem like it's doing better, in the hopes that he lowered the down payment requirement, that more people would rush out and buy homes. And they did. But then after he got reelected, he raised it back up to 3.5%. It's political gamesmanship. That's what politicians do. Okay. Now, when interest rates, they change, they fluctuate in the money market on a regular basis. When interest rates are high, people get that adjustable rate mortgages. We got those government programs that offer for higher LTVs like the FHA and the VA loans. But we also have state programs through the New Jersey Housing Mortgage and Finance Agency, or NJHMFA is the abbreviation. They have various loan programs. They don't lend money. They're just like the FHA. They don't lend money. They just have these loan programs that approve lenders if they have borrowers that meet certain lending requirements and the property they're buying meets their requirements. Those local lenders will give those loans, and the NJHMFA will insure those loans, just like the FHA. So what does that mean? They insure the lender against loss. So in the event the borrower defaults in making their payments, the FHA or the NJHMFA will step in and foreclose and pay off the balance of what's owed. The USDA, yeah, those are the people that check our food, isn't it? They inspect the food, they inspect the crops, they inspect the farms, right? They inspect your meat, USDA approved, prime rib, right? Well, USDA gives loans to people who live in rural areas. That includes farmers or just people who live in rural areas where the housing is not that close. You can't quite see your neighbor. They're that far away. Okay. That's a rural area. Okay. They give loans through what they call one of their departments that handles that. It's called the REC-D, the Rural Economic Community Development. So they give loans to farmers, people who live in rural areas, and those who even live on Indian reservations. So I talked about rural. What is rural? What is urban? What is suburban? Okay, don't answer those questions. I've gotten some wacky answers from students before. Let's not go there. So what is an urban area? It's a densely populated area with lots of high rises, apartment buildings, and people living in a close proximity. It's like the city, the inner city, right? So here you can see in this circle, I got 3 rings here that I created through AI. We have the urban area as a highly populated population density that's tightly compacted, high rises and apartment buildings, a lot of people living within a close proximity of each other. Suburban areas are a lower population density. The homes are spread a little further out. It's less high rises and apartment buildings and more one and two family more 1 and 2 family houses. That's suburban. It's not quite urban, it's suburban. You're still close to cities and all the modern conveniences and all that, but people live a little bit further apart from each other, as you can see in this ring. That's suburban areas. And then we have rural areas where people are living out in the country. It's farmland where people's houses are not that close to each other. They're living out in the country. They may not be living close to each other. That is what's considered rural. But it's based on population density. You'd be surprised to learn that Franklin, over in Somerset, just on the other side of New Brunswick, it's actually considered rural. Because it's based on population density. Here's another explanation, another meme I created for that. The city, like that taxi cab with our free advertising on there. Got our logo. So the city, it's the high rises, right? It's densely populated areas. Then you got the suburban areas, also referred to as suburbia, the suburbs, the burbs, if you will. It's a little bit less densely populated with more single family and 2-family homes than apartments and high rises. And then you got the rural, which is countryside, farmland areas. They're sparsely populated areas. Get a cow. All right, so let's go over the anatomy, or actually let's talk a little bit about fixed rate loan programs, ones that the interest rates don't adjust as the money market adjusts. So the word amortize means to kill off slowly over time. And that's exactly what it does. It kills off debt slowly over time. On page 268, we're on, under payment plans. The word amortize means to kill off debt slowly over time. And it does, agonizingly slow, over 30 years. That's the typical loan that most people get, right? So, fully amortized loan. If amortize means to kill off slowly over time, fully amortized means you're fully killing it off over time. So your payment amounts don't change. Your first payment to your last in your 30-year mortgage over the life of the loan remains the same. If it's a fixed rate loan. And by the time you make your last payment, the balance would be zero. Now, in a fully amortized loan, payments get applied first to the interest owed and the balance towards the principal. The principal is the amount you borrow over the term. The term is how many years, how many payments. So typical loans that people use to buy real estate is a 30-year loan. So on a 30-year fixed rate loan, by the time you made your last payment, the loan's been fully amortized or fully killed off. So your balance would be zero. In a straight loan is an interest-only loan. You'll never pay down the debt, the principal that you borrow. So that's why it's meant for short-term loans only. It's an interest-only payment loan. You're only paying on the interest. This is often used as a second mortgage, as a bridge loan. When when a buyer purchases, let's read what I got here on this. When the buyer purchases a new home before they close on the sale of their existing home, we usually try to coincide closings so that they close on the sale of their existing home and the purchase of their new home within 30 days of each other, so that they avoid having to make a mortgage loan payment on two houses. Most people can't afford to make two mortgage loan payments a month, right? So an alternative there is a short-term loan called a bridge loan that bridges the gap between the time that you buy the new property and the time to sell the existing one. These are meant as short-term loans that are not meant for longer than 6 months. And then we have, it's also used for builders and fixer people who investors who fix and flip properties and builders. Okay, it's a short-term loan, and then when they sell the property, they pay it off in full. So let's do the highlights now. Let me know when you got the highlights. Green. Everybody has that?
Yes.
Right? So partially amortized loans partially kills off the loan over time. Amortized means to kill off. So if it's partially amortized, that means it's only been partially killed. What? What? Yeah, by the time you make your last payment, it's only been partially killed off. There's going to still be a balance at the end. So the last payment has to be larger to kill off that balance. You got to put one more bullet in that loan to kill it off, right? And the way you're going to do that is make a larger payment. So the last payment must be larger than the rest to fully amortize it. So that last larger payment, it balloons in size. And because it balloons in size, it's called a balloon payment. Another term to know. So the benefit to getting a partially amortized loan would be that throughout the whole loan term, the monthly payments are a little bit lower. They're tacked on to the end, and then you pay it off at the end with that last payment that's larger than the rest that we call what do we call it?
Balloon payment.
A balloon payment. Now, there's also something called a biweekly mortgage. Now, a lot of people misinterpret this as making two payments a month. No. It consists of half payments made every 2 weeks. the equivalent of 26 half payments per year or 13 monthly payments. Hey, aren't there only 12 months in a year? Yeah. But if you were to base it off of the number of weeks, it comes out to 26 half payments, the equivalent of 13 months. So you're basically making an extra payment, but it's kind of transparent because it's kind of like when you come home every day, you throw your change in a pot or a bucket, right? And then you add up your money at the end of the year, and then you apply that as an extra payment. It's transparent. You don't even realize that you're doing it. For those who don't know how to save that money, if they take that money out of their pocket and put it in that bucket, and you see they got that bucket, so they got to go out and have a little party time with it. Okay. People who can't have money burning a hole in their pocket, well, they could set it up like this. Doing half payments every 2 weeks, the lender will make that payment for you. That one extra payment gets applied entirely towards the principal, not the interest. So you could, if you do this, if you make one extra mortgage payment a year and you apply it towards the principal, entirely towards the principal, you can reduce the term on a 30-year fixed rate loan down to 23 or 22 years. Yeah, you can knock 7 or 8 years off of the loan payments, just by making that one extra payment a year and applying it towards the principal. If you made that one extra payment, instead of saving it up little by little, if you made that one extra payment at the beginning of each year, you save even more. Why? Because you're lowering the balance that they could be charging you interest on. So it kills off that loan quicker. Let me give you an idea. What's the average home price in New Jersey now? I mean, it's higher than it is throughout the nation. But you guys know what the average is? Let me take a look. Let's see if I can put it in AI, see if AI will give us an answer. What is the average price in New Jersey 2026? Jesus. Higher than what I thought. Anybody know? Anybody know?
I would say 550,000.
You're pretty much close, but it's 600,000. That's 600,000 as of April 2026. The single family median home price is 600,000. Zillow's home valuation index, it's 578. The median sale price from from New Jersey Realtors, they say it's about 570. Yeah, so you're about there, between 550 and $600,000. Damn. I live in Union County. Union County's 2026 single family median sits at $677,500. Oh, crap, well above the statewide average. So very affordable for the first-time home buyers, the young person looking for their first starter home, right? Great place to buy real estate. No wonder why so many adults are moving back in with their parents. All right, yeah, don't blame you. Let's see, partially amortized bi-weekly. Let me get that back up on the screen. Did you know, why did I ever look that up to begin with? Okay, so we see that it's about $600,000, right? If you're in Union County, it's above $600,000. If you have a $300,000 loan, because I did the math on this. If you have a $300,000 loan at a 5% interest rate, we already learned that the going interest rates are mid 6% now, right? Mid to high 6%. If you have a $300,000 loan, that's half of what the average is right now, at a 5% interest rate, that's lower than what you could probably get out there right now. If you make if you pay off your loan, if you get a 25-year loan instead of a 30-year loan, so this is a little bit different than having a 30-year loan and making an extra payment every year. The math on it's just a little bit different. You'd probably save more making that extra payment every year. But let's just say that you had a 25-year loan versus a 30-year loan at a 5% interest rate for a $300,000 loan amount. You would knock off about $55,000 a year. It's about $54,000 a year in interest payments. You would save about $54,000 in interest payments by having a loan that pays off 5 years sooner. So if you make one extra payment a year on your mortgage loan, you could knock off 7 to 8 years that they're charging you interest on, but because you keep reducing your principal, the amount you borrow, you're paying it back sooner. You're saving that money in interest. By the way, if you get a $300,000 loan at only a 5% interest rate, do you know how much you would have paid back if you keep that loan for 30 years? You know how much you would have paid back? How much does that $300,000 loan cost you? How much would you pay back if you borrowed $300,000 at a 5% interest rate over 30 years? Anyone got a guesstimate for me? It's about $585,000, $590,000. That's almost 100%,
That's crazy.
isn't it? And that's only at a 5% interest rate. Most people, they don't even consider that. They don't even look at it. Why? Because they look at, well, what's my monthly mortgage payment? Can I afford the monthly mortgage payment? They don't actually look at the numbers to see how much that loan would actually cost you. And that's only at a 5% interest rate, which you can't get right now. Or most people couldn't anyway. You may be able to if you got excellent credit, a lot of collateral, big down payment. You may be able to. But so most people aren't getting that right now. Okay. But if you got a 5% interest rate at only a $300,000 loan, which is half of what the houses are going for right now, your average home is going for right now, which is insane in itself, New Jersey's home prices, how they're inflated. That $300,000 loan will cost you about $600,000 or $585,000, $590,000. Yeah. I share your sentiment there. That's crazy. Cray. All right, so let's highlight this notes here about fixed rate loans, biweekly mortgages, etc., and the partially amortized loans with the balloon payment. Do the highlights, and then I will switch. Yeah, let's just do those highlights for now. Oh, we'll do those highlights, and then we're done for today, actually. That's as far as we're getting.